is where everything gets very peaceful before a big disruption. Congress gets this phenomenon. It's like last week's calm district work period before now facing a month of unpredictable governance in the House. While it's easy these days to predict chaos in our politics, Congress also needs to spot other possible disasters while we are in a calm period. So I want to thank my colleague, Chairwoman McLean, for calling this hearing. Too many of us get lulled into a false sense of security, and nowhere is that truer than with financial crises. Over and over again, when the economy is strong, politicians are so busy taking credit that they fail to see storms on the horizon. Last spring, government leaders were shocked when Silicon Valley Bank, Signature Bank, First Republic all collapsed. Most folks hadn't thought about bank failures since the financial crisis of 2008, but all of a sudden, those banks failed. Businesses were at risk of not making payroll or failing, deepening the storm. Even though we weathered that storm, the government should have seen it coming. Why didn't we? Maybe because Congress was negligent during the calm. In 2018, Republicans were joined by over 4 dozen Democratic lawmakers to greenlight a bill that made it easier for banks to legally take a position where the banks would be less likely to be able to pay their depositors when they wanted their money back. That law increased the risk of a storm, but Washington was too busy enjoying the calm to prepare for it. The 2008 financial crisis is the same story. Washington thought that mortgage markets would be okay. Mortgages where you can choose what to pay, lending 115% of a home's value, what could go wrong besides everything? Yet the Federal Reserve itself insisted the risk was under control, with Chairman Greenspan saying in 2006 that, quote, there is no evidence that home prices will collapse, quote, and later admitting that, quote, he didn't see it coming, quote. Why? Because he didn't look, and neither did Congress, which praised Greenspan right up until they blamed him. It really makes you wonder, what financial warning signs are we ignoring right now in this period of calm? Look no further than commercial real estate. This year, commercial property owners across the country are due to repay $929 billion in debt. That debt is held by banks, hedge funds, investment vehicles, pension funds, and others. If we don't want a major financial meltdown, the vast majority of that debt needs to be paid back. But commercial property owners are having a hard time doing that. Property owners aren't making the same money that they did before the pandemic. The businesses who were their tenants canceled or didn't renew leases, and many cannot make payments, especially with rising interest rates. And those interest rates make it harder to sell their properties or pay off their mortgages. And to make it even worse, some local governments are doubling down on the commercial real estate crisis. Can you believe how aligned we are?
I know. Cats and dogs living together.
That's right. Can I be the dog? Okay. Today, any property transfer in Los Angeles County worth more than $10 million gets taxed at a whopping 6%. This kind of big tax change adds huge risk to the commercial real estate market at the worst possible time. It compounds the risk of a major collapse that all levels of government should be working together to prevent. Look, commercial property owners take risks, and losing money is one of them. But when the whole market crashes, that causes a problem that hurts all of us. It could mean widespread unemployment, bank failures, and slow economic growth. So what do the banks and other lenders do? They keep extending due dates for loans, hoping that commercial property owners will eventually get into a better place to pay them back. But that hasn't happened even after a few years of extensions. Ultimately, property owners will need to pay back the loans or they will default on them. Those are the only two choices. The longer we postpone the outcome, the bigger the balance grows and the greater the economic risk becomes. Problems never get smaller when you push them into the future, and this one will get bigger. Let's try to prevent or minimize a future storm for our economy while we're still in the calm. I yield back.
Thank you. I am pleased to welcome.
Mr. Turner, as a trained attorney, I am not supposed to ask a question I don't know the answer to, but I am so about to do that because I trust and believe in you, okay? So don't let me down. I want to level set really quickly. Inflation, Biden-induced or pandemic-induced?
Goodness, no pressure. Thank you for that. I think that first of all, and as was said earlier.
Hold on, I've got 5 minutes and I got a lot of questions. So just real quick, Biden or
there was a period of extraordinarily low interest rates after the 2008. So for that, I mean, over the long term, the average 30-year mortgage rate, which is what I'm most familiar with in housing, I think that it was much more supply chain COVID related than anything President Biden or the
Thank you so much. My next question is, as it relates to inflation, is this a domestic inflation or has inflation been global?
Well, there are others who can speak much more to global economics than I can, with my expertise being.
But you agree with me that it was global?
It is. There are very few markets anymore that are purely domestic.
Okay.
Particularly for financial products.
Thank you. So I just want to make sure that we level set with that really quickly about the fact that the inflation that we're experiencing has not been a Biden-Harris induced inflation, but pandemic related, as well as inflation has been global and not domestic or limited to domestic, as well as the fact that the United States is actually rebounding better as it relates to our inflation than some of our other counterparts that are similarly situated. So I wanted to make sure that we talked about that really quickly. In addition to the fact that every time we come into this committee, it seems like maybe once every few months, we got to start blaming these government workers for not going to work because they lazy. That's what we hear, is that all of our problems in the world are because of telework. If I had a dime for every time we blamed telework, then I may have enough money to pay Trump's legal fees for his 4 criminal indictments. But nevertheless, what I'd like to make sure that I get admitted into the record. So, Madam Chairwoman, I would ask unanimous consent to enter into the record a 2024 white paper from 2024 Brookfield
Without
published.
objection.
Okay, thank you. All right, so there's a couple of things that I want to talk about. Is there a problem as it relates to commercial real estate right now? Yes, there is. And I appreciate your response that you just had about the fact that it's not necessarily the same as 2008. It is nothing like 2008 from everything that I can tell. And that's coming from the business major side of me that is speaking. But I do want us to make sure that we focus on a couple of things that are going on. At one point in time, we used to have a thing called a typewriter, and then we moved on to computers, and then we moved on to computers with the internet. At another point in time, we used to have this thing called a telegram, and then we moved on to landline telephones, and then we moved on to cell phones. And at one point in time, we used to have horse and buggy, and then we moved on to gasoline operated vehicles, and now we're moving on to e-vehicles. Here is the deal. We have a transitioning workforce. We understand that while a lot of people were not in their offices specifically because of the pandemic, we know that some companies and corporations saw benefits in not being in the building as they had to adjust because of the pandemic. But they found that, you know what? Maybe this is where we should develop. And they decided to do that. And I think that that's okay, but we now have to adjust. So I want to talk to you about solutions. I don't want to just say, well, you know, back before the pandemic, everything was back before the pandemic. A lot of people didn't die either. So yes, there's a lot of things that I would prefer did not take place as a result of the pandemic, but I just can't go back. And so I want to talk about solutions because that's what we're supposed to do in Congress. Instead, we play games. But I'm going to be real with you. And I want to ask y'all questions. Anybody can jump in. In my opinion, as we have these commercial buildings that are sitting vacant for whatever reasons, and it seemed like the numbers were ticking up for those businesses specifically as it relates to commercial properties. Would it be helpful if the federal government offered a subsidy of some sort or some sort of incentive to convert some of that commercial real estate that's sitting there empty into, say, housing, because that would solve two issues that we currently have. We have a housing supply issue, and we also have an issue as it relates to the cost that a lot of commercial property is enduring right now. Anybody jump in? And
think it'd
Madam
be very,
Chairwoman, I
very-
just ask that you allow them to answer. Thank you.
Ma'am, it would be very, very helpful if there was some sort of federal subsidy. A lot of state and local governments are providing incentives to convert. Here in DC, there are some. New York has some, other cities. But the federal government could be very helpful with some sort of a conversion tax credit, perhaps modeled after the rehab tax credit that's in law now, or something. These conversions, as Mr. Turner mentioned, are extremely expensive. It's not good for every building, but it's good for some. And it would, as you said, help housing, and it would help cities and so forth. So the answer is yes.
Thank you so much.
And by the way, Mr. Gomez, who's on this committee, has been working on a bill in this area that could be very helpful.
I will let them know that you have
Consider when
lobbied for him.
deciding whether or not to give a borrower more time to pay a commercial mortgage.
Okay, that varies significantly, and it probably varies significantly on their capital source and their oversight.
Let me limit it to office.
Okay, but again, it depends on the lender. Does the lender have the ability in capacity to extend the loan? That's kind of the first criteria, right? If it's a securitized mortgage with Wall Street, they can't simply do that.
Okay, great. Let's actually pause there. I just looked at helpful testimony, and you're right, whoever said it, that banks' biggest exposure in commercial real estate is not office. But it is the biggest chunk of the commercial mortgage-backed security market. Am I correct? I looked at the chart. It's red. I'm pretty sure this is what you gave me. So how do we work those out?
Not my area of expertise, but they go to a special servicer, and those special servicers are very busy. And they consult with the owner, and they consult with the bondholders. And effectively, there's a process there for determining just what you said. Do we have an ability to extend this loan and not take repayment with the bondholders in exchange with something else of the owner?
But is there enough flexibility in the terms of most of those commercial mortgage-backed security agreements to allow that kind of negotiation? Because this was a huge problem in RMBS, as you recall. Is it going to be better or different here?
I think there's somebody in the back of the room I just met who has better experience with that, who could explain it. I know they're busy. It seems as if the system thus far is working. And in the meantime, the CMBS market is issuing new debt to help its way out of this cycle.
Well, I mean, respectfully, I think issuing new debt to help its way out is what it always does. Whether it works or not is a little bit different story. I think that's what Wall Street does, and it's a good thing, but I don't know that we can look to that as necessarily a positive sign. I mean, I guess I'm mostly worried about this hearing has been really wide ranging. And I think one of the things I've taken from it is we ought to have some more hearings, because the concerns that I have not been fully satisfied with what we've said about the office situation, and particularly with regard to the CMBS and the life insurance companies, who have very, very different regulatory relationships than banks. And I think we need to dig into that a little bit more. I mean, part of what I'm concerned about is, and this goes to what the chairwoman was saying, is that this kind of mowing and waiting, I'll call it, like the owner of the property, he's mowing the grass and he's waiting for the market to turn, and the kind of pretend and extend mindset is going to hit its limits at some point. How long do you think we can sustain kind of extensions in office space the way we have been?
Again, I don't want to be avoiding the question directly, but it's very circumstantial. I know certain life insurance companies have pretty much budgeted a 5-year program for this, saying that we don't expect a recovery in this space to occur this year or next. And anything we structure, we want to give 5 years to. So they're looking at an extended way.
Okay, let me ask Mr. DeBoer. one of the things that commercial real estate has gone up a lot in the last decade, 2014, 2022, about the last 8, 10 years, 90%. And that's not multifamily, that's the more traditional commercial real estate. Given that it's gone up so much, why did these companies fail to pay down? I mean, in other words, it's one thing when your property value is declining and you have very limited options. I understand it's more expensive to refinance today. I understand that the income on the properties is lower than it is today, but your property's worth a lot more than it was. Have they continually levered up to where the loan to value ratio has continued to be high? Could you turn your microphone on? Yeah, thank you.
I think your point is a very good point, but not everyone bought in 2012. And so the vintage, I think, was referenced earlier. If someone bought in 2012, 2013, low interest rates, they have seen a substantial increase in their value. They have seen equity created, okay? But that's not necessarily true for the 2019, 2020 buyer. And there again, it depends. When you asked about what someone would look at on extending loan, what is the vintage of the property? What is the financial strength of that borrower? Do they have capital to put in to justify extending that loan? That's the best I can do on that. But your point is obviously perfectly correct. But again, with rates going up 550 basis points or whatever you have a tremendous impact on value and a destruction of equity at the same time that you're requiring new equity to go in to refinance. At the same time, you need new equity to amenitize that building.
You chew up a lot of that added value with all of those things put together.
Right. I mean,
do you mind? I know I'm over time, but do you mind? Otherwise, I'm going to ask for another round. So you might as well just let me keep going. I want to talk about HUD. I know that the chairwoman had this on her mind as well. Tell us why. I think this is your testimony, Mr. Weidel, that you said something along the lines of HUD is quickly becoming the most expensive, difficult. One of you said this, and I know it wasn't Mr. Turner, that HUD is quickly becoming one of the most difficult, expensive places to do multifamily. And the volume at HUD for multifamily is down 75% in the last 2 fiscal years. We were both, Ms. McLean and I were both really like, tell us more. Why? And what can we do about that? Because that seems counter to everything that we've said about supply.
Well, thank you for noticing that. And that's what we think as well. We're all talking about building more affordable housing, and here's an opportunity to do it, and it's not getting done.
Well, it's going the wrong direction even.
Correct. And as a practitioner, I haven't done a lot of HUD business because it's generally the lender of last resort at this point. The process is way too long. The requirements are way too great. They evolve, they get added during the process, and particularly with the rise in interest rates, it just made a lot of projects unfeasible that may have been put into the pipeline 2 years ago. And by the time they got into the HUD pipeline now with all of these requirements, they don't work.
So I just want to make sure I'm understanding this. So it's not that there's been any huge wild change in the requirements. You may think there's too many, someone else may think there's not enough. Let's just posit they've basically stayed the same, but what you're saying is now that interest rates are higher, you're paying more for the money to do the project. You don't have as much left over to absorb all of the costs of the loan itself.
There are new ones, I'm
Okay.
being reminded, and I know there were a couple that came out just last week that we're really not in favor of. But these things, what happens is obviously during good times, you could kind of overcome some of these obstacles, but
Well, if money's cheap, that helps.
when money's cheap, it helps and you can get through all of this. When money got expensive, then all of these things really mattered, and that's where we are.